Hello and welcome. You're watching us here on Trading Hour. We come to you live from the CNBC-TV18 Motilal Oswal studio. I'm Mangalam Malu, with me Hormas Vatakia and Ritu Singh. And the market's doing exactly what the market's been doing over the last few trading sessions at this hour, trying to flit between red and green, make up its mind. Over the last few trading sessions, we've seen a clear trend emerges only in the second half of trade, where the first half is used as, a period to while away some time or make some decisions. And tomorrow is a holiday, so ahead of that, maybe the market is still fairly indecisive. But the broader range for the Nifty, between 25,500 and 26,000, that 500-point range between which the market remains volatile, continues. The good part today, though, is the mid-cap index is seeing a fair amount of recovery from the lows at the high point of trade, with a gain of almost 112 points. And we have the stocks which are advancing, pretty much outnumbering the stocks which are declining by a smidge. But a smidge it is. If you look at the, crisscross lines, they've just about intersected with the green one a little over the red one as we speak. Ritu, I'm a Metallica fan, but you're a Gojira and Slipknot and all those heavy metal band fans. And you'd be happy because of the genre that the market is playing right now. We have, the Nifty Metals Index, which is up, 2.5% as against the other indices which are doing nothing.
Yes, the Nifty Metal Index, that's up about 2.6% now as we speak. And Nigel has been telling us about it all morning, especially that note that came in on Vedanta. But, on the back of those soaring metal prices, almost every, name on that pack, they're doing pretty well. The energy pack as well, putting some energy into the markets. Volatile, though, it has been as we start this Wednesday. And I guess more cues will come in as we get more earnings through the day. The IT packs have started the season. That, the Nifty IT pack is still, though, in the red as we speak. The advance decline ratio, Mangalam, that you were talking about, actually more in favor of advances now. That seems to be improving. Let's see if this uptrend sustains. But let's go across to Hormas as he puts the spotlight on the top movers in the trading day today.
Well, as Mangalam was also highlighting, most of the other indices are doing precious little, but that does not take away from the fact that there are enough and more movers in the broader markets that are making noise in today's session in the first couple of hours. Starting off with, of course, the metal names, as you all were highlighting earlier as well. Look at Vedanta now 6% higher at a record high. Hindustan Zinc's record high is 800 rupees plus, so it is hurtling towards those levels as well. And Nalco, another record high for the stock today as well, 3% higher on this name too. And take a look at the volumes now and look at Vedanta's volumes. We have had 1.5 crore shares being traded already. The 20-day average is 50 lakh shares. Hindustan Zinc has had more than 1 crore shares. Nalco has had almost 1 crore shares as well. All of them significantly above, at least twice or 3x their 20-day average when it comes to today's trading volumes. Actually, a couple of names that are doing well today, HEG and Graphite India, both of them have snapped a 5-day losing streak in today's session. HEG is up 5, Graphite is up 7.5, and they continue to do well in today's trade after the underperformance that they had previously. You look at HEG has had 30 lakh shares traded, which is 3x its 20-day average, and Graphite India too has had at least 2.5 times its 20-day average when it comes to today's volumes, more than 13 lakh shares that have been traded. On the downside today, there has been a very sharp fall that has been seen in Go Digit General Insurance. Now, this stock at one point was down almost 5%. You're seeing some recovery from the lows. Now, as a top loser at one point on the Nifty 500, has declined in 6 out of the last 7 trading sessions now. The volumes today are already the highest in the last 3 months. Now, today's volumes, we have seen over 13 lakh shares that have already been traded. The 20-day average here is only 50,000 shares. And as a result of this down move today, the stock has moved below its key moving averages. And from its post-listing high, which is close to around 380, 385, the stock is down around 15% from those levels and is now closing in on its IPO price, which is around 272 rupees.
All right, Hormas, we take that point. We were talking about heavy metals and the music there. Do you have any particular preference in that genre?
Give me good 90s music and I am a happy kid.
90s Bollywood?
Yes.
All right, take that point. Ritu, 90s Bollywood, any picks out there?
Well, no top picks there, but, nothing else matters right now. It's the markets we must get back to focus on. It is the realty space, I think, that we're going to next.
Yes, we are. Let's go across to Sonal, who's joining in on Purvankara, the third quarter business update. That stock soaring higher among the few non-metal stocks which are buzzing around today. Up 11% on that. The street likes it, Sonal.
The street likes it, as you guys have been pointing out and talking about Bollywood music. There's some music, at least in this name, after the gloom and doom that we've been talking about in the realty space overall. Now remember, Nifty Realty Index, that's down almost 20% from 52-week high. So any news is lapped up by the markets, and Puravankara is one of them. Their pre-sales are up both on a quarter-on-quarter and on a YOY basis in the quarter gone by. Their volumes are up 4% on a YOY basis. They are down 1% on a sequential basis. Collections are up both on a quarter-on-quarter and on a YOY basis. Now, for realty companies, volumes are also very important because it gives an idea of how much area you have sold. Because sales value can be a function of pricing, their sales mix, and also the ticket price of any apartment. Collections have been higher as well, so that is another positive news. The company says that they handed over 1.23 million square feet, delivered around 1,100 homes in the quarter gone by, so delivery also very important. During 9 months, they had an area launched at around 2.83 million square feet. That also spoke about new launches that came by. So good going, good commentary, and street is taking some cues from that. At least this stock is higher in trade, but Nifty Realty continues to be under pressure.
Oh, Nifty Realty continues to remain under pressure indeed. Sonal, thank you for summarizing that for us. 11% higher on Puravankara. And since Sonal was mentioning the Nifty Realty space, look at Signature Global. That continues to grind lower now. 2.5% gone in today's session as well. Prestige Estates, it's down 2. Lodha is down 1.5% as well. Godrej Properties continues to move lower. As of yesterday's trade, Godrej Properties was at the lowest level since December of 2023. So it was a multi-year low for Godrej Properties, and another 1.25% shaved off in today's trading session as well. Now, barring Go Digit, though, as we just mentioned, the other stock that's not doing well is Hexaware. That is now down to the lows of the day as well, 3% lower on Hexaware Technology. So keep an eye out on that name as well. But the one stock that was seeing some relentless selling pressure over the last couple of months has been Dixon Technologies. And this is after the fall that you saw in yesterday's trade when the stock was down 5%. Even today, the stock has given up most of its gains, now only 0.5% higher. Upasana is here to tell us about a bearish note that has come in from Phillip Capital. Upasana.
Well, certainly, Hormaz. Well, declining volumes from Motorola continue to remain one of the key concerns. Now, Phillip Capital has given a sell rating with a target price of 9,085 per share. It says that the volumes from Motorola, which is Dixon's largest client, declined 20% on year-on-year basis in Q3 FY26. Dixon has significant client dependence on Motorola, which accounted for nearly 45% of its total revenue in FY25. Over the couple of last quarters, Motorola's volume have been declining sharply, which is why the stock continued to remain under pressure. And even, mind you, the approval of the Vivo JV, that is also the street is awaiting. If there are any delays there as well, remains one of the key concerns. Now, the brokerage says that the Dixon's volume from Motorola has been declining mainly because of the two reasons. Motorola as a brand has been facing strong competition from Apple, which resulted in muted sales in Q3 FY26. And the other greater issue is the increased outsourcing to Carbon. Motorola outsourced nearly 23% of its volumes to Carbon in Q3 FY26. Hence, it believes that the mobile phone assembly has little to no moat, but increased competition will result in declining volumes for Dixon from FY27 is what the note has highlighted and emphasized on. So overall, a sell rating with a target price of 9,085 per share.
All right, Upasana, thanks very much. We'll leave it at that. No friend of mystery. Dixon, though, recovering a bit in trade today, now up about 0.6%. Let's slip into a break. Up next, we're going to focus on the bond market with Manisha Gupta, so stay tuned for that.
And India Bonds presents Bond Street. Welcome back, and at Bond Street today we talk about various bond issues which are likely at the India private placements in the very near future. Most of them actually are in this week itself. So let me list them out to you. And the first one that comes in on your screen is Electronica Finance. They're looking at 1 billion rupees, and July 16, 2031 bonds is how they're looking at in sense of issuance there. Samman Capital wants to raise 2 billion rupees, and this is via 10-year bonds onto that one as well. There has been a board approval for Muthoot Finance as well for raising 3 billion rupees via 10-year bonds. These are just 3 of them. I have some 10 on the list right now. Take a look at some other ones, and you have Emerald Haven Properties, which is 1.08 billion rupees of an issuance. They're looking to raise that much via 2-year bonds. IFL Finance also is looking to raise via 2-year bonds, and the amount that they're looking at is 160 million rupees. You have Vedika Credit Capital, 800 million rupees for them. July 31, 2028 bonds is what they're eyeing on to this one here. And then you have Torrent Pharma, you have REC as well looking at 1.5 trillion, a higher amount therein via NCDs. Prestige Estates has 20 billion rupees via NCDs and sense of an issuance. And there is, I understand, a board approval also for JSW Steel. 50 billion is what they're looking to raise as well via NCDs onto that one too. And then you have Torrent Pharma, I talked about that. 30 billion rupees is what they're looking to raise via NCDs. But Axis Bank chooses to go via debt route to raise 350 billion rupees as well. All of these openings, basically the bidding that is, happens today and tomorrow for most of them. And then Bank of Maharashtra is looking at infra bonds. They've done that in past as well. 100 billion rupees is what they're looking to raise as well. Well, those are all the private placements that we're looking at via corporate NCDs or debt that are coming in this week there. But with that, let's go into a short break. When we come back, we'll talk more about markets and stock specifics.
CNBC-TV18 and India Bonds presents Bond Street.
Welcome back to Trading Hour. It's 14 or 15 points up on the Nifty as we speak. The markets are making a bit of a recovery. The broader indices have swung back in the green for now. Sensex up about 1.6 points. The mid-cap index has been up and about since morning. That's also up about 150 points as we speak. And the bank Nifty making a recovery as well, up by about 40 points as we speak. But that said, it's been a volatile trading day, Mangalam. What are the FNOQs coming in and telling ahead of that holiday tomorrow as well?
Well, it is a holiday tomorrow, because of which the Sensex expiry has been brought forward to Wednesday as against Thursday that it happened. So it makes 2 consecutive days of expiry. So yesterday was the Nifty weekly options expiry. Along with that, today we have the Sensex expiry, which is taking place. Ahead of that, the key indices, they are in a narrow range. The street wants some more trends to emerge before, the market either decides to break down or break out. But the good part is that the mid-cap index is outperforming, more stocks advancing than the number of stocks that are declining. And the metal stocks, they're shining in trade today. Not only is the metal index up around 2.8%, the ferrous names, which have not been doing too well, they're doing a lot better as well. Tata Steel, among the top Nifty gainers with a gain of almost 4.5%. JSW Steel, not too far behind as well. But if you look at the non-ferrous names, there you have the big moves. Zinc, Hindustan Copper, Vedanta. The record rally continues for the above 2 and Vedanta as well on the back of that Nuvama note. But if you look at some of the banking gainers too, we have Axis Bank and IndusInd Bank. Remember, with the last few trading sessions, it was ICICI Bank which was doing well, or you had some off days where, HDFC Bank would do well as well. These weren't as big participants in the move that we saw in the earlier banking names. Now these stocks are buzzing around as well. For the markets though, the street still believes that we're in a range, which is why we're seeing writing at both the 25,700 call and the 25,700 put. What this implies is that those who are writing the straddle, which is a call and a put together, are expecting the market to be in a bit of a range. 250 points on either side of 25,700, which is roughly 25,450 to about 25,950 is what the range for the next week is. That's the combined premium on the 25,700 put and the 25,700 call. And that ties in technically as well. If you look at the 100-day moving average as a support at around 25,550 and the 50 and the 20-day moving averages as resistance around that 25,950 to 26,000 mark, that's the broad range that the Nifty has been playing over the last few trading sessions as well. But amidst all of this, there are a bunch of stocks which are seeing a lot of shorting. That's Tata Elxsi, Federal Bank and Kalyan Jewellers. And among the non-ferrous, non-metal names, one stock which stands out in terms of long positions being added is Laurus Labs, up around 3.5%, has had a great 2025 and is doing well. at the start of 2026 so far as well.
Carrying on from where it left off is Laurus Labs, so back over 1,000 rupees as we speak. Mangalam, thank you for that F&O update. By the way, ICICI Lombard has now moved to the lowest point of the day, 2.5% lower on that stock. On the flip side, Canara Bank has moved to the highest point of the day, and that is the PSU banks that have been the outperformers right through 2025 and are now carrying on that performance in 2026 as well, 1.5% higher for Canara Bank, where 25,750 is where the Nifty currently lies. Good time to get in a chart check. Mehul Kothari from Anand Rathi joins in for just that. Mehul, good morning. Thank you for joining in. Been meandering around this 25,600, 25,800 range now after trying to hit new records, but then could not sustain at those levels. So your call on the index now and your stock recommendations for the morning.
Morning, Hormas. Thanks for having me on the show. Well, earlier we saw a clear-cut breakout failure in Nifty near 26,300 when it made a new high. Post that, what we saw is index slip below 25,700 level, confirming a short-term breakdown. However, downside also failed to sustain, and Nifty briefly moved below 25,500 but managed to cover swiftly from there, recover swiftly from there. So as of now, at this stage, what we are seeing is a breakdown failure in the index. This will get further confirmation once Nifty starts trading decisively above 25,900 mark, which is quite far away from here. So a move above this 25,900 level should improve market sentiment and could open up room for higher levels. On the downside, as of now, 25,400 zone remains a crucial support for now. As long as this level holds, the sharp panic selling appears limited. So at the same time, volatility is picking up. India VIX has turned up from a historic base near 9 and is now trading above 11. So with key global events, geopolitical risks, trade war concerns and union budget ahead, I feel volatility is likely to remain elevated. So given the upcoming budget, we feel sector-specific action should be seen. Budget-linked themes such as railways, defense, infrastructure and capital good stocks may remain under the limelight. So overall market may stay choppy from here on. So selective stock specific approach with the strict risk management will be important in the near term.
Okay, and Mehul, selective stock specific approach. Where does the banking pack stand in there? We have a bunch of heavyweights reporting earnings in the next few days. You have ICICI Bank, HDFC Bank. The stock prices there have been pretty volatile, dragging the Nifty one day, pulling it up the other. Any top picks from that pack?
See, if you talk about private banks, actually we do have picks. We have picks from railway and metal space, but talking about banking, we feel that there is a very limited upside for banking because if we look at the entire banking index, that is Bank Nifty, 60,500 to 61,000, that zone from where it has turned from the higher levels, that is a very strong resistance because there is a long-term trend line, rising trend line over there. So it would be very difficult, even if they rally from here on, like private banks names like Kotak or ICICI or HDFC, even if they rally from here on and Bank Nifty, let's assume it goes again to 6,500. So it would be very difficult to sustain at those levels.
Do you have any other stocks that you fancy, Mehul, currently?
Yeah, a couple of stocks from the railway space we are liking. Actually, the entire railway space we are liking from here on. But RVNL is our pick. So one can buy it in the range of 335 to 330 with a stop loss of 303 and upside potential of 380 over a period of time. Metal is another space that is showing improving price structure. So from the metals pack, we are liking SAIL. One can look to buy SAIL near 152 odd levels, keeping a stop loss near 143 and upside target of 162 followed by 168.
All right, take that point. Thank you so much for joining in, Mehul. We'll take a short break, come back on the other side. We'll get you more of the markets, a lot of individual stock-specific action coming up your way.
Well, 40 points higher on the index now is a sudden up move that you have seen just after Mangalam summarization of the FNOQs. 25,770 is where the index currently stands at. But shifting focus to the consumption space, Mangalam today has put together a piece on the anatomy of India's consumption story. Mangalam, take it away.
Well, it's the third quarter, which is very important because it offers the first credible stress test of India's consumption recovery narrative, along with the festive season. Because, at the same time, if you look at it, the thing that we're looking to get an answer to is, has policy met behavior? By September 2025, the government had already pulled almost every lever available to revive demand. Income tax cuts, GST rationalization, food inflation had moderated, rural cash flows were also supported by a healthy monsoon, and interest rates had peaked with expectations of easing ahead. So the question is, have these policy measures changed how Indians actually spent? So to look at all of that, I looked at every other metric that could tell you about consumption. Auto volumes, they remain one of the cleanest indicators of household confidence out there as well. Two-wheelers grew about 19%. Three-wheelers rose about 20% in the third quarter. These are retail sales. Tractor volumes surged over 50%. And these are not urban luxury purchases. They reflect improved rural incomes, mobility and demand, along with livelihood and passenger confidence. If you look at passenger vehicles, that grew just about 3.5%. Commercial vehicles grew 14%. This implies entry-level consumption is recovering faster than aspirational big-ticket urban spends, and that's exactly what one would expect 9 months into policy-led recovery. Then I looked at the credit card spends that Ritu speaks about. Nearly 1.9 lakh crore worth spending in November 2025, growing 11.5% year-on-year. And these are spends that capture discretionary spending on a real-time basis. The RBI data too shows retail credit growth remains skewed towards categories like housing and auto loans, while unsecured credit growth has moderated. At the same time, average spend per card has declined sequentially to about 16,500 rupees from about 18,800 rupees. Consumers are spending more in aggregate, but spending smaller amounts per transaction, also led by GST-led cuts. Online transactions, they accounted for nearly 60% of the credit card spends in November. Now, this has two implications. First, consumption is becoming easier to express via online expenditure. And secondly, demand recovery may not always show up in traditional retail metrics that we look at immediately, especially where price deflation has reset reported revenues. That brings us to the FMCG sector. Across FMCG as well, demand has improved sequentially while pricing has softened. Volume growth has improved over the last year, but reported revenue growth remained restrained to near mid-single digits. For staples at large, because this was not because consumers weren't buying, it's because prices had come down due to GST rationalization in September that reset MRPs across multiple staples and mass categories. At the same time, some of these input costs like palm oil, copra, crude derivatives, and packaging, all of them softened, as a result of which volume growth returned ahead of value growth. That's a healthier foundation for a consumption cycle more than margin-led expansion. And Goldman Sachs, in its recent note, highlighted that earnings downgrade cycle for consumer staples is likely behind that. And that assessment aligns closely with what the data on the third quarter is showing on the ground as well. Discretionary pickup too has been a standout. According to the government's latest advance estimates, if you look at what the government is saying, private final consumption expenditure continues to grow steadily as a share of GDP, supported by stable inflation and rising rural incomes. Demand has been the early beneficiary from rural side, whereas urban consumption still remains on a slow recovery path. In previous cycles, policy-led stimulus often resulted in sharp but short-lived consumption spikes. This time, it appears that the recovery is slower but structurally stronger. Finally, to the question, has consumption picked up? The answer is yes. But has it broken out? Not yet. The third quarter marks the point where policy intent, affordability, income stability, and consumer behavior finally align. But the real acceleration, if it comes, will depend on wage growth, interest rate easing, and sustained confidence. After everything the government has done, the consumers finally responding, just not recklessly.
All right, responding they are, just not recklessly, but a more structural recovery is the important takeaway. Mangalam, thanks very much for putting that into perspective so well. We have to take a short break, but don't go anywhere. We'll get you more on the markets on the other side and also get chatting with Devang Mehta of Spark Private Wealth Management.
25,760, where the index currently lies around 35 points higher as we speak. So a bit of a recovery coming in from the lows of the day. Devang Mehta from Spark Private Wealth is now joining in to discuss more on the markets ahead of this important earnings season. Devang, good morning. Thank you for joining in. The only talking point over the last few months has been metals, the rally in metals, gold prices, silver prices, and so on. With the kind of run-up that the prices have seen now, do you still believe that one should hold on, book profits? What do you do in metals? And also, if you do have a preference here, where does your preference lie? Ferrous, non-ferrous, and so on.
Good morning, Hormas. Yes, I think it's very important that we discuss a little bit of a global narrative to what you asked about the metals. It's very important that global geopolitics is dominating once again at the start of 2026, and we all know that how probably gold has generally been a safe haven when people talk about impending wars or geopolitical tensions, or as such, a lot of economies probably having difficulties in sort of negotiating with tariff. Sense that yes, this rally which has started off last one and a half year could probably have some more steam left. There are back on the back of fundamentals. I don't know whether gold and silver would rise from here on, but yes, people talk about silver being a industrial metal, and sort of a lot of things are still pending on that front. So that really still goes on. My other sense is that all this ferrous and non-ferrous metals also, there's a lot of demand coming, industrial demand coming up, not only in India, but also across the globe. So my sense that yes, if somebody is holding on to the trade, he can probably keep it for a couple of months more. But anybody wanting to come fresh into this market, I think the risk reward would not be that favorable.
All right, risk reward not that favorable in the metal space right now if one was to chase this rally. What about the banking space? The banking index has been outperforming, and a lot of people are overweight on financials. But we haven't seen like a rip-roaring rally in any of these NBFCs, banks, or barring gold financiers rather. So are there any pockets which look good out there? If you could give us some indication of what you are liking. Is it PSUs? Is it private sector banks? Is it large caps? Is it mid caps?
Mangalam, very importantly, I think we like the BFSI as a space. For sure, it's generally underperformed the market last couple of years. But most importantly, ex-banks, there are a lot of financial stocks, right? The capital market proxies. And I know it will sound a bit cliche, but these exchanges which are already listed, there are depository companies, there are AMCs, wealth management, broking outfits. I think this will compound fast. If somebody has a 3 to 5 year horizon, I always say this, that out of the 460 lakh crores of market cap in India, roughly around 130 lakh crore belong to BFSI. Out of this, of course, banks are the biggest, followed by certain NBFCs. But if somebody wants to compound a little more faster over the next 3-5 years and has to be a CAGR, I think then a lot of such financials can come into place, capital marketplace, which can grow a lot faster than banks. Banks probably could post 10, 12, 14% type of credit growth. But this segments can grow at 18, 20, 22% also if somebody has a longer horizon. So that's, I think, the space that one should be if the horizon is 3 to 5 years.
Devang, what about the consumption space? I mean, the government has done a whole lot. If you just heard, Manglam also was telling us, whether that was the tax cuts, the GST cuts, the RBI has brought down rates significantly over the past year. And with the budget coming up as well, how would you realign your portfolio, on consumption space, one? Secondly, any other sectors where you might be trimming your position or increasing it?
Three sectors typically, a very good question. Three sectors typically find favor when we construct portfolios, and of course, credit growth, consumption, as well as your capex related companies. So my sense that there is a lot of consumption now which has come back to the fore, and I was looking at the analysis done by Mangalam Malu just before the show, where he was talking about how discretionary consumption, the upper end consumption, and even the lower end consumption, the likes of companies which operate in the rural areas and the semi-urban areas, they also come back with a bang. So I think a combination of companies in discretionary consumption, little bit of discretionary consumption, companies like Titan, just giving certain examples, companies in the hotel space. All this could probably do very well. The travel arena can do very well if I talk about consumption. If you count auto as a part of consumption, yes, probably India now sells more SUVs than the entry-level cars. That's also one space one should probably look at. On the capex side, yes, we like a lot of engineering companies, capital good companies, power HVDC related companies, which have corrected in this last market fall, the last 3-4 months. But that space also looks interesting. And along with that, the financialization space I talked about, the capital marketplace. These three themes look very attractive. Somebody constructs a portfolio today as well.
All right, Devang, thank you so much for joining in and giving us your view on a whole host of sectors. We leave it at that. Wish you a very happy Makar Sankranti and season's greetings as well. While we were talking about the consumption space, a proxy to the consumption space perhaps could also be the express delivery logistics space. And look at delivery. The stock has been a massive underperformer. The stock is now finding some favor at the high point of trade. The reason for that could be that today at around noon is the Shadowfax IPO press meet. So maybe, another player coming in this space could have a bit of a rub-off impact and some renewed interest in the delivery stock, because as a business is concerned, there is a fair amount of tailwinds because e-commerce packages, parcels are growing. Delivery has obviously, bought a couple of these large players as well. So now among the largest non-third-party players here, but at the same time, or rather the largest third-party players here, non-captive players here, but at the same time, the bigger risk is when, large clients like Meesho, etc., move on to their captive logistics. So an interesting space, an interesting proxy to play the new age consumption recovery as well. So Meesho yesterday announced that they will enter their own captive logistics, while delivery is moving higher ahead of the Shadowfax IPO press meet today. We'll take a short break actually. As we take that break, let's get you some important opinion coming in from the CIOs who joined us at the CNBC-TV18 Market Forum yesterday. They flagged 2026 year as a year of recalibration, pointing to PE contraction, mean reversion across all asset classes, and a renewed focus on broader markets. Listen in, take that break, come back.
Looking back, difficult 2025.
Yeah. Okay.
And I see fragile 2026, not only for India, for global. The challenge which I see in 2026 is not about India. The risk which we are referring is not related to India. Worry is about US market because extraordinary complacency is there. And I see that's one of the big risks of 2026, where developed market will correct and they can correct sharply. And I'm taking a big call. This year belongs to P contraction. Global P will contract. And this is the thesis which is based on some of the analytics which we do. And the biggest risk which I see coming is the rise of dollar index, because it's a consensus trade among all the strategists and the economists globally. The de-dollarization thesis is which did, obviously dollar has depreciated last year. I think long-term perspective, I also believe that we are in structural downtrend for dollar, but from a near-term and medium-term perspective, that's the risk which I see.
Tahir, if you want to give a headline to us, what is your broad outlook for 26? Mean reversion is something that you're looking at?
It's quite likely that in many ways we are set up for a mean reversion in many things.
Yeah.
I mean, everything from the point of view of, the dollar, as you mentioned, to let's say even our own earnings trajectory. I mean, it has been poor. Can we probably improve in the next year or so? Can we probably see our underperformance relative to many of the emerging markets? We've seen significant amount of underperformance in the last 1 year. Can that mean revert? Can we see mean reversion in the global markets, as he indicated, that, the whole AI trade, which is dominated and led to almost a bubble kind of scenario developing. So in many ways, I think this is what we have to probably prepare ourselves for. And I think we'll have to be a lot more astute.
All right, Nilesh, let me get you in then. That's an interesting couple of calls that we've got. Peaking out of the mother market probably, and the dollar index that we were getting used to slipping, maybe it's bottoming out and mean reversion, as Tahir said as well. But Nilesh, how do you view it? 2025 was a very, very tricky year.
Yeah.
Going by the headlines, you should have had a rocking year. That wasn't to be. How's 2026? And what's the big theme or the big call that you're taking for 2026?
I think there were three headwinds which caused correction over the last 15, 18 months, and all three are receding, in fact, turning favorable. One is related to macro environment, both globally and domestic. Then related earnings momentum, which also slowed down. And of course, the valuation premium also. Valuations were high about 15, 18 months back. So on macros, all of us know there has been massive sort of turnaround or stimulus, both from the fiscal side. A monetary engine has been firing. We have income tax cuts, more money in the hands of people. We have interest rates reduction by 125 basis point. Will full impact, we'll see it. And of course, from the monetary side, again, massive, apart from the reduction in interest rates, injection of liquidity, etc. So it will take a bit of time, but we'll see earnings moving. Again, retracing back. Last 2 years, earning growth has been in single digit, low single digit, in fact. We see it moving over the next couple of years to more like low teens, etc.
Oh.
So in that context, I think the view is positive, constructive. Of course, from a macro construct, the only thing which is sort of missing is what's happening on the trade part. But apart from that, we have very strong flows. We have reversion in the earnings momentum. So I think 1 year again is difficult to predict in equities, but next few years should be pretty solid. Only thing I would like to say is if you're looking for steady long-term returns, then this is a good sort of market. But however, if you're looking for quick and easy money, I think that era may not be sort of what we saw in 23 and 24 may rightfully pause here.
Two sectors which you guys are bullish on for 26 and two sectors which is a complete avoid for you.
I will say power is a theme. It's a global theme.
Okay.
Last year it underperformed. So if I have to look at
the power index, by the way, was down 6% last year, and it's part of the mean reversion, which normally turns positive.
So that's the one theme which we think should play out very well.
Okay.
Second thing is about generic company, pharma company, which are not at all affected by the Trump tariff, whether it's 20, whether it's 500, doesn't matter. They are exempt space. That's the area where India has edge.
Okay.
And what IT did 20 years back, we think next 20 years pharma can do that. So
what's a complete avoid for you? The two sectors which are complete avoid.
See, if I have to say completely avoid, obviously I will take a clue from our call. If we are saying that NVIDIA is the best shot for 2026, though it has not peaked out, it may take some more time, but that is the best shot, then I will avoid new age companies because if I'm talking about P contraction, then all expensive, most admired territory and most valuable stocks should be completely avoidable.
Welcome back to Trading Hour. Let's get you the macro signal cues for the day. And first up, the markets. It's 47 points up on the Nifty, 25,779 is where it's at. The Sensex has also made a bit of a recovery, now up 125 points. Bank Nifty lagging the markets, but still in the green, up 55 points, about 0.1%. Now, the US inflation data also came out yesterday. That lifted the dollar, and so some rupee weakness was expected on the back of that. Incidentally, though, when asked about the rupee volatility, the RBI governor, Sanjay Malhotra, yesterday commented that markets are going to ultimately determine the prices, and their policy has never been to target a level, only curb volatility. Currently trading at 90.21 to the dollar. Keep in mind, 90.28 to 90.30 has been widely viewed as the near-term support for the rupee by market participants, because that's a level where RBI has typically stepped in to curb volatility. Let's also pull up the oil prices. Brent crude prices have touched their highest level in 12 weeks at $66 per barrel. Now it's cooled off a bit to 65.31. This follows the protests that have been happening in Iran, that possible US intervention after that tweet from Donald Trump saying help was on its way. Now trading at 65.3 per barrel as we speak. Shares of ONGC, Oil India, they also saw some gains on the back of that rise in prices. Onto the bond market action, where bond yields have been volatile. Remember, yesterday there was a 30 to 50 basis point up move after the Bloomberg Index Services deferred the inclusion of Indian bonds on the global aggregate index. 6.63 is where we closed yesterday, and now we're continuing to inch up. The 10-year now at about 6.64. As we speak. Lastly, the global growth signal coming in from the World Bank. They released their global economic prospect report overnight, and the message is pretty cautiously constructive. They say the global economy is proving more resilient than they had expected, despite all these trade tensions and uncertainty remaining high. So global growth is now projected at 2.6% this year, rising slightly to 2.7% next year. And from there, an upward revision to an earlier forecast. This improvement, they say, is largely because of the stronger than expected growth in United States. That alone accounted for nearly 2/3 of the upgrade that we're seeing. But there's a very clear warning coming in beneath that optimism that, if these forecasts do play out, the 2020s will still be the weakest decade for global growth since the 1960s. For India, the growth again has seen an upward momentum. 7.2% is the upgrade coming in for FY26, supported by domestic cues. Before growth eases to 6.5% the following year, and then settling at 6.6% in FY28. All this is assuming 50% tariffs from the US. The World Bank has also flagged one more important jobs challenge ahead. 1.2 billion, that's the number, keep in mind, of the young people that will enter the workforce in developing economies in the next decade. And it warns that if there is no sustained pickup in investment and some reforms underway, many countries will fail to absorb this expanding workforce, a critical long-term signal for policymakers and markets alike, especially ahead of that budget coming up.
Take that point, Ritu, entirely, and that 1.2 billion people, a large part of that perhaps coming in from India as well, where we do need some job creation, as we looked at in the consumption space as well, to fuel that wage rate and wage growth. Extremely crucial. But before we draw curtains on this edition of Trading Hour, here's a sneak peek into the stocks that we will be addressing on your stocks today. Don't forget to catch fundamental and technical experts' analysis and views on these stocks that you can see on your screens. Daily, you can write to us and we will address these stocks or the stocks that you want us to address with our experts only on CNBC-TV18 at your stocks.